Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is a joy. She is at Columbia University and for years with Goldman Sachs. Abby Joseph Cohen joins us now at an important time for the nation. Abby, let me go out to 60,000 feet. With this administration, with the yin and yang almost of this old administration to new and all, do we risk giving up American productivity? For whatever reason, are we close to where we upset the long-term glow and efficiency of America?
Tom, I know that you've always had this focus on productivity, and I'm glad that you do. Because as you and I both know, long-term economic growth and long-term wealth creation, and I'm talking about national wealth, personal wealth, rather than stock market erratic wealth, is very much related to productivity. And I do think that some decisions that have been made and continue to be made right now will be damaging the nation's long-term productivity growth. I'll give you a few examples. First of all, even during prior administrations, we were seeing that our national investment in science and technology as a percentage of GDP had gone down. And it has gone down even further during the last few months. Cancellation just yesterday, for example, postponement rather, of all NIH grants announced yesterday is an indication of loss of productivity, future productivity in the bio research area. We've also seen enormous cutbacks in grants from the National Science Foundation, NASA, and so on. And these are the things that really gave us a leg up in terms of our technology, especially with regard to things like computer science and a number of other categories that are going to be so critical for the future.
Abby, we're going to hear from the Federal Reserve Bank today, and you know, so much cross currents out there, and probably some political pressures that this Fed has not had to deal with for a very, very long time. Right. What do you expect to hear today?
I think, like everyone else, I will be on tenterhooks. But I think the consensus probably has it right that the Fed, for the time being, would like to hold tight on interest rate policy. Keep in mind that even the GDP report this morning had those cross currents in it. The top line might have looked good, but things like real final sales are showing signs of deceleration, consumer spending decelerating, and very importantly, back to Tom's question about productivity, we see that business investment, CapEx, for example, is also slowing. And these are things that we need to be watching carefully. But let's remember that the Fed is under pressure, not just on interest rate policy, but on some other things, including its very important supervisory and regulatory function within financial services. And then, of course, there are the questions about the building. I would say that I worked in two of those buildings, and they were in desperate need of renovation.
Desperate need of renovation. So Abby, when you think about, these markets here today and some of the trade policies that maybe the market's trying to discount here, the political issues, the geopolitical issues for topics around the world, are you surprised that the equity market snapped back as well as it did? And we're talking about new all-time highs on a daily basis?
Well, as you point out, the equity market did snap back, especially after those announcements in April. And I think the key reason for it has been that economic data has been okay. As I mentioned before, there are now some signs of deceleration, but certainly not recession. And corporate profits have been quite robust, particularly in sectors that have been favored. I think that the real question will be in the second half of this year, once we see what happens as companies are now beginning to adjust for the tariff policies they see. For example, the announcements just over the last few companies by Procter and Gamble and Hershey, and of course some of those pharmaceutical companies.
Abby Joseph Cohen with us of Columbia, and of course, decades at Goldman Sachs. Abby, are you a bull in this oddest of markets where people you and I know and respect have 10 holdings that are 40, even 50% of their portfolio? Is this a legitimate bull market that you can believe in?
This is a legitimate bull market. The question is, how much further can it go? The concentration that we've seen in a small number of extremely well-performing shares, and of course, the valuation. Valuations are just not all that appealing. If we look at the S&P 500 overall, it is, sort of at record deciles. Vis-a-vis PE, price to sales, price to book, and so on. Doesn't mean that there aren't some value opportunities, but I think that investors really need to be very careful. And one of the things that I always go back to is that when the market is undervalued, when the market is too cheap, and there are disappointments, perhaps on economics or geopolitics. The market has shock absorbers. But when things are already priced for perfection, then you really need to be careful, because that's when the volatility picks up. And we have seen, for example, that when there are those periods in which it's not clear what economic policy will be or what's happening in the rest of the world, we do see that volatility picking up. And volatility works in both directions. Not just up, but also down.
Abby, what have you seen so far, and what do you expect to see in the second quarter earnings that we're dealing with at the moment?
The second quarter earnings have actually been quite good, and that I'm sure is a relief to many people. My focus, however, has been on guidance. What are these companies telling us about the future? And we are hearing more and more companies saying they are concerned about tariffs. They've not been forced, if you will, to focus in detail on it, because nobody really knows what the tariff structure is going to be. There's been a sigh of relief that the tariff focus will not be as high as it might have been in April. But where we are right now, 15 to 18% on average expectation for tariff rates, that's extremely high. Yeah. That's Smoot-Hawley level. And the comments that have been made by some saying, oh, look how much money we're collecting from tariffs. That's great. It's going to help us on the deficit. Well, I would say, hold on a second. Those tariffs are being collected in large part from American businesses and American consumers. It's a sales tax, and it's something that is not helpful for economic growth. Thus far, what we have seen in corporate reports is that companies willing to absorb to this point, but as they have a better sense of what the tariff structure will really be, they may adjust their policies.
Abby, I got 20 seconds. It's 100 degrees out. Can Ovechkin do it one more year for the Washington Capitals?
I certainly hope so. I've got my jersey ready.
Very good. Abby Joseph Cohen, thank you so much, with Columbia University, sitting right behind the bench in Washington Capitals. Opening, that'll be in October, I believe. First week of October is the tradition.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
It's exciting. We got Wu Silverman with us now, RBC Capital Markets, into the great fundamental analysis, the mathematics of Abby Joseph Cohen at Columbia University. When you were coming up, and I was the same way, how did you study Abby Joseph Cohen? She was ensconced at Goldman Sachs, hugely active within the CFA Institute. How did you study the applied mathematics of Abby Joseph Cohen?
Well, first, I was at Goldman, and Abby Joseph Cohen was the star, so it's very cool.
Did you ever speak to her?
I was too afraid. I was like a lowly associate in the derivatives research department. I just, I looked from afar. But, one thing I appreciated, and that became part of the background, is like a lot of the white paper analysis is kind of the fundamentals. It creates the background for a lot of our analysis going forward, looking at back tests, looking at systematic factors. And that's our framework now at RBC and derivatives.
We look at the VIX here. Tom makes us look at the VIX. He beats us over the head every day looking at the VIX. Why? It's here at below 16. It just feels like it should be higher than that. I don't know. It's crazy out there, but we have a VIX that seems pretty benign here. How do you think about that?
It looks completely benign. You know, I've been joking that I've got to bring back my paddling duck market analogy because I think it still suits the market here. Look, the one fact I would add, though, is that realized volatility, so 30-day S&P realized volatility is 8. Right. So if you look at that volatility risk premium, it's actually fairly fat. But, you know, our joke on the team has been it's a good time to rent gamma. It's a good time to
what does that mean?
Yeah, what does that mean?
Essentially, it just means it's a good time to own a little bit of the idea that volatility could increase from here. Because just given what you guys just said, think about the heavyweights reporting today. Think about what Powell could say today. And yet we're implying an S&P straddle that suggests nothing is going to happen today.
Within the idea of betting on more volatility, betting on more acceleration, if you will, in price change, is there a bet in this summer? Is there a bet on Wall Street? Are people exposed?
So there is not a bet. Now, there is a bet. We've talked about this before, Tom, longer term. So more in those October through December buckets, you're starting to see more hedging activity. But my one fun fact is when you look at August over the last decade, VIX typically rises about 18%. August is a volatility pothole month. It's a month where folks go on vacation, investors maybe not as much at their desk. You get those liquidity vacuums, and maybe you get an August 5th where VIX spikes to, you know, the 60s. That's happened before. We're not prepared for that. We're still in July, and we're happy as a clam.
So, I mean, I've been in this market game since '86. September, October, I don't like those periods. I mean, I was on the stock exchange floor in '87, not good. How do you think about that? Do you see clients positioning for volatility in the fall when people maybe do get back to their desks?
Yeah, I think essentially clients are planning on positioning, but they have not yet because it's a little too early and the name of the game in options is not to have to burn premium. But what I'll tell you is there's been kind of two divergent narratives, right? So the retail population has been about buy the dip. It has worked for them, but there's always been this institutional angst. It really hasn't gone away.
That hasn't gone away in the early summer.
It has not gone away. It has not. I think it's just being very tactical about when to deploy it.
This is so critical. If they are behind, if their angst has not gone away, what's the emotion of institutions when they're, oops, it's August, we're behind?
Yeah.
Are they like retail where they're like, let's get on board, hold your nose, let's buy Apple or whatever?
You know, the one thing we've seen in financial history since COVID is it's not just a left tail risk. There's also this right tail risk, and it's very real. Like you can no longer think of it as something that occasionally happens. Like you've now gotten to May 2020, 2021, these meme crazes, right? These are very real risks that you as a portfolio manager are just as exposed to. If your benchmark runs away from you, you're hedging on the upside as much as you're hedging on the downside, Tom.
Amy Wu Silverman with us, RBC Capital Markets. Thrilled to have her with us. Joseph Cohen joining us in about 20 minutes here. Red and green on the screen. The VIX, 15.86.
So you mentioned meme stocks, and Amy, whenever I see that, and we see it from time to time, that to me is a red flag that, all right, this market's getting a little silly here. And how do you pros think about it? Because just from a layperson, when I see that stuff, I get nervous.
I'd say two things. The first is, and I'll bring this back to GameStop. So the reason GameStop became an issue for the broader market was at one point was actually 40% of all of the XRT, so the retail ETF. It started to become a benchmark risk for folks who didn't want to have anything to do with it. I'd have investors tell me, I don't care, this is a sideshow, but then they're starting to get that concentration risk in the benchmark. We're not there yet. It's been a little bit of, a storm in a tea kettle, but if that starts to spread, you better believe, again, that right tail risk is going to spread and people have to catch it.
I look at the math, and let's go to the cross moments. Folks, we're not going to get into it. It's the summer, my head's hurting. But if you look at the variance study, the kurtosis study, the rest of it, is the math working right now for pros?
I think one thing that all us folks who work in derivatives have to do, and, this is a slug, so you got to update these spreadsheets. Maybe AI can help, but the rise of zero data expiry trading really just changes how we have to think about things. We used to have the standard monitor that's 1 month, 3 months, 6 months, 12 months. That's your standard chart structure. It kind of has to be, right? Because everything's happening in such shorter duration. I've kind of called it this theme of duration shrinkage, meaning we're getting just as much activity, but it's very concentrated.
Taleb, is that then on theta, the x-axis? Is it your advantage because of the focus short term to make your bets out longer term? Is Nassim Taleb took small, longer term bets?
Yeah, so you can get, what I will say is the reason I think zero data expiry is appealing is because you get less of that problem with theta, less of that carry problem. But what it has also done is people are paying less attention, I think, to the longer tenors, which have been telling us something this entire time. So I think it has sliced both ways. And what you want to deploy, I think it really depends on your risk framework.
We're going to hear from a couple of big stocks after the close today, Microsoft and Meta/Facebook. And that kind of goes to the concern that some people have about concentration risk in this market. How is that expressed? Is your market, the derivatives market, is that concern about concentration risk, is that there? And are people trying to hedge it somehow?
It's 100% there. And so one thing we like to look at is to think about, one of our other themes is just how the meat is made really matters. You don't know what's in that sausage. And so I'll just give an example. I'll give a component like XLC. So the S&P Communications ETF, you go into your Bloomberg and you go to MEMB, and what do you find there? 2 to 3 stocks max, right? And so some of the opportunities that we think are interesting is to essentially own the options of the ETFs where it's essentially the same meat, but it's not pricing as if it is the same
this is your famous line here, how the meat is made, is a general statement. You can go in cash market, buy the ETF, buy whatever, buy NVIDIA, or you can buy the option, which is basically 4-to-1 leverage. You're using 1/4 of the cash as a simplistic statement. Or you could buy futures ages ago before you were born, where it would be 10-to-1. You'd put up 1/10 the money. Is there an implied leverage there based on how the meat is being made today?
Sure. So one thing I'll say that's interesting about NVIDIA, and this is why I think when people ask me, are we at peak froth? I say no, because if we were, we'd start to see that call exuberance in NVIDIA the same way we saw it in May 2021, which is when you have to start worrying about that right tail risk. It's very clear right now we are not pricing that.
Why?
I think because, like this, one, the meme craze is its own thing right now. It hasn't spread. But 2, there still are these institutional concerns that have not gone away about tariff transmission, about valuation, about a whole host of other things that, again, you don't see in the near term, but have not changed from the longer terms.
You've mentioned ETFs several times this morning here. How pervasive are ETFs as part of just derivatives trading and hedging and that kind of stuff?
I mean, ETFs kind of trade like water. So something like the Qs or SPY, from an options perspective, these are just as active as your big Mag 7 names. And then in options, it gets even more fun because it's not triple levered all cash, Tom. It's actually just triple levered Qs or NVIDIA or what have you. It just amazes. It never ceases to amaze me how much people pile into leverage.
But is there almost like is there a hidden leverage in the market given legit derivatives or crafted marketing derivatives, if you will? Is it like 87? I didn't know what portfolio insurance was until a Thursday evening at 6 p.m. with a cocktail in my hand in October of 87. Is there a leverage issue out there because of all this newfangled stuff?
So I get asked this a lot. My short answer is I don't think so. I think, again, the meat is made has changed. I don't think we're in a February 2018 Volmageddon situation, which you did have with a lot of the inverse levered ATPs. So like your TVIX, your SVXY, that imploded. Lots of fun. But, what we have in the market that's grown a lot in notional are more your plain vanilla overriding strategies, which just has a different sense of leverage.
I mean, velocity shares 2 times VIX. I mean, just
you can have a lot of fun
ETF for
these
everything.
days. Yes.
I mean, you got to stay on top of this. Amy, does your world care about 2 o'clock today with the Federal Reserve Chairman and what we hear?
I think very much so, and I think there's been this hotly contested. Do we get a crack into September? Does he admit that maybe there possibly could be an opening? I think that's going to be again a reason to rent gamma.
Right, we're going to see Amy Wu Silverman with us with RBC Capital Markets this morning. Let me get one more in here quickly. The idea here of this bull market in Mag 7. Can you play derivatives in Mag 7?
Absolutely. And look, if you are bulled up, Tom, in NVIDIA, again, that call skew, that call exuberance where everyone's piling into those options, not seeing that yet for August 27th earnings.
Amy Wu Silverman, thank you. RBC Capital Market.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
My first intern at Bloomberg was of high achievement and got one of the great coveted scholarships and jobs. He migrated to State Department years ago. Ryan Majerus was under Raimondo at Commerce and a very extinguished career in trade, in law, in Washington. And he joins us now. He's the former Assistant General Counsel for U.S. Trade. As a broad sense for President Biden. Ryan, thrilled to have you with us. This is arguably our interview of the day. What was it like at Georgetown when you won a Harry S. Truman scholarship? That had to have been life-changing.
You know, it definitely set me on kind of a different trajectory for sure. And you'll get a kick out of this, but at Georgetown, my worst grade in undergrad was actually international trade. So I've always wanted to go back and talk to that professor and say, you know, look what I've done since then.
the qualities C.
Yeah. You know, what's interesting is I think back on my college experience at the Hilltop, which was great, but you know, it was at a time when globalization was kind of at its peak. Yeah. And really every lecture I had in college was about how globalization is a tide that, you know, lifts all boats. Everybody is better off from the kind of the value added from globalization. And I sat there in those lectures thinking, I feel like we're missing half the story here. And I think what we've seen with this administration in the past decade kind of underscores that.
What is so important here and why I think this interview is timely is all the smart people of whatever their politics say these are verbal agreements and not written agreements of detail. Discuss how you perceive the Japanese and EU deals that the president says are massive. Except, is anything written down?
So this is a very different way of negotiating trade agreements. And I actually don't think you can look at these framework deals in the traditional sense as trade agreements that we've seen in the past, where there's multiple negotiating rounds, where you refine the text before it gets to the principle and then it's issued. I really view these as the start of negotiating rounds that we're going to see over the next weeks, months, and maybe even years. The reality is it takes a long time to get at this significant kind of politically entrenched trade issues between countries. And I do think at the end of the day, that is what they're trying to get at. They're frustrated by years and years of jobs getting offshored and want to deal with those non-tariff barriers and unbalanced trade through different levels of tariffs by trying to counteract that and get folks to the negotiating table. There's clearly a shock and awe aspect to this, to, you know, threaten the use of tariffs and bring them to the table. But right now, I think we're seeing the result of that. There hasn't been enough time to, you know, really negotiate among the parties. And you're seeing these kind of like high level framework deals that have investment commitments, but it's unclear at this stage where they're going to go. I think we're going to see more discussions.
Ryan, why do you think the Trump administration believes it's good trade policy to tax American businesses and tax American consumers to bring back manufacturing jobs to an economy that is already at full employment?
So I think the story is a bit more complicated than that. Certainly, there is going to be degrees of tariffs getting passed on to consumers. That's unquestionable. But, you know, they're trying to deal with these kind of broader concerns of we have liberalized our market over the last 70 or 80 years. And other countries have not done that to the same degree. And I really do think at the end of the day, you have to, even with all the kind of shifting sands in the trade policy and the on again, off again, at the end of the day, they're trying to bring back manufacturing jobs and rebalance trade. And they think the tariffs are the best way to do that, that they create leverage and they're going to get folks to the table. And there's no question it's done that. I think the ultimate question will be, what are the impacts of this? What are the kind of
Ryan,
headwinds that we're...
Is the president listening to our conversation?
Oh, I'm sure he is. I'm sure he is. Ryan, aren't the greatest beneficiaries of globalization the American consumer?
But undoubtedly, we've benefited.
So why are we
heavily
changing policy here?
So there's two sides to the story. We've benefited from globalization, but there's no question that admitting China to the WTO and kind of the broader scope approach that we took with globalization has had impacts on the country. And so I think you're seeing kind of a response to that.
Ryan, the president tweets now, the August 1st deadline is the August 1st deadline. It stands strong and will not be extended. A big day for America. Ryan, is August 1st a big day for all Americans?
I honestly think they're going to issue a lot of tariffs on August 1st. I don't think we're going to see many extensions. I think we may see them on China. But, I think they feel empowered to, despite the high level of tariffs that we're currently seeing. We have an average tariff rate of nearly 20%. The stock market's doing great. Consumer prices have started to uptick, but aren't as concerning as feared. Inflation hasn't ticked up. So until those things start to become headwinds, significant headwinds, I think they're going to feel emboldened to try this out and test it.
And John Tucker, you had Hershey reporting, and you stated the tariffs came in much higher for Hershey's chocolates than expected.
I think it was like $180 million is what the tab's going to be from the earlier projection in May. I think.
Is this where we're heading, Ryan?
15.
I mean, as a final question, is this where the path we're heading to? Is a substantial intake on tariffs and expense?
I think so. I think we're going to see that tariff rate stay in the 15 to 20% range going forward, unless we start to see these headwinds take hold.
This has been wonderful. Ryan, don't be a stranger. Love to have you in. Ms. King and Spalding, Ryan Majerus with us, the former Assistant General Counsel of Trade.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Mark Howard with us now, BNP Paribas, with a really, really smart talk, talking about the optimist trifecta that could be out there. But you bring up a word which I'm going to associate, ages ago with the likes of Robert Mundell and Jacob Frenkel, which is trilemma. And in the foreign exchange and international space, a trilemma indicates that within a system, there's a constraint. On this crazy Wednesday, with the news flow we have, what is the constraint in the system that we have? Is it monetary policy? Is it this trade fiasco we're in? What's the constraint in our trilemma?
Well, I guess, Tom, there are a number, and good morning. Thanks for having me. I think the constraint has been, for most of the year, has been overarching uncertainty, the unknown, and that's been holding back corporate America in particular away from the Mag 7. It's been holding back animal spirits. And with the passage of the big, beautiful bill, with the resilience of the economy, and with getting deals, preliminary deals done with key partners like the UK, Japan, and the EU, some of that uncertainty is fading. And we're seeing animal spirits pick up, Tom. We're seeing M&A. Look at the Union Pacific deal. Look at some other M&A that's in the works. And the comments we heard from big M&A banks recently. So the big constraint has been uncertainty, and I think that constraint is starting to wane.
So what do we do here? I mean, I think that a lot of folks are saying, boy, the stocks look expensive, 22-ish times PE. Credit spreads are tight. Boy, gold's had a rip. Where do are you looking for value, or are you just looking for quality here and just saying, I can hold my nose at values?
It's a little bit of both, and sometimes we're just looking for generic carry or yield. It's not, because that uncertainty can come back with just a tweet or two, with a shock, a tsunami. Who knows? There's a lot of outliers that can destabilize these days. But yes, quality with growth that is levered to a firm economy in the U.S. and slightly diminishing uncertainty is what we're looking for.
Are all we're talking about, I mean, with the unknown of the European deal, the unknown of the Japanese deal, maybe the unknown of the legislation, are all we living here on this huge day is a lot of stimulus and a lot of tone of deregulation?
Tom, I think that's a great way to put it.
Is that the sum of where we are.
Yeah, the big beautiful bill is a lot of stimulus, tax cuts and targeted spending.
And overlaid on a Union Pacific deregulation, just to
yes,
pick on a train.
And in the banking sector, deregulation there, changes at the Fed and other oversight bodies. But importantly, there's also the AI evolution. And that's, we're going to hear a lot of that today
from
and
Microsoft
tomorrow. And that's also a catalyst, not just for the Mag 7, but for your firm, for my firm. It's being deployed more broadly, and that is fueling growth that's under the surface.
Mark, so what are we doing here, U.S. versus rest of the world? There was a trade earlier this year where a lot of folks were taking money out of the U.S., maybe even the U.S. dollar, the U.S. stock market, and employing it in the rest of the world. Was that kind of a short-term trade, or is there something else going on out there? What do you see?
Well, I think that was a tactical rebalance to reflect both the acute uncertainty in April and as well as the divergent prospects or hopes for more stimulus, more growth in Japan and in Europe and other parts of the world. Now we've seen a more of an equilibrium, and the de-dollarization, as people call it, I think is much more of a slow burn. It's not. It is not a significant theme that we're hearing from clients in the near term. But when you talk about 26, 27, I think it will continue to be a force, particularly with the steepness of the curve and the prospects for some cuts next year.
BNP Paribas has a just fabulous Pacific Rim heritage. I was honored to be part of that years ago. And if I look at your study of EM, the fact is dollar is really doing well against EM. There's a lot. I looked at Argentine peso today, and it's grim. I mean, is this the main story? The surprise for the second half is dollar resilience?
You know, I think that is a story, Tom. I don't know that that's the story. I think that we had a major 10+% move in the dollar versus the basket, and that's an outlier. You don't see that every year. So I think we're going to settle into more of a groove around that, and other things will influence the major pairs, including the EM pairs. But we're seeing a lot of money go into EM assets, as you can imagine, as the hunt for return and the hunt for yield, and frankly, an alternative to the dollar.
Mark, thank you so much for starting us strong today. Mark Howard in studio with us. He's with BNP Paribas, a senior multi-asset specialist.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Ari Wald with us right now. I had a technical analysis, Oppenheimer. Ari, in the fundamental space, John Stolfus making headlines with an optimism on a bull market. Is this bull market chartable? Does this bull market display a trend?
It sure does. Following its fresh breakout above its February high points, I think the key message that we've been conveying to clients here is that the rally is surely overbought, but that doesn't mean that the bull market is over. That historically, when you get these very swift recoveries from a 52-week low to a 52-week high, actually been followed by above average forward returns for the S&P. So I think this is consistent with an intact bull market. We do want to invest for a third-year bull market, however, with that said.
So, Ari, I'm just looking at the relative strength index for the S&P 500. It's now at 71.8, typically suggesting an overbought here. How do you think about that short term?
It is. Well, that's a difficult timing indicator. I was looking at that. I heard you lead in with the RSI, and I quickly checked it out myself. It hit 70 actually coming into July. That was right ahead of a 3.5% rally in the S&P 500. So that relative strength indicator, that's a measurement of the speed of price. It's indicating that price is still accelerating. That's actually a good thing. We call that confirmation in the technical analysis space. Typically, you want to see those divergences and signs of deceleration before getting more concerned.
How do you use volume? My school of thought, Ari, is I really try to ignore volume as noise. I would suggest you go another way. How do you treat volume in this odd summer of a bull market?
It's a great question. It's really become secondary confirmation for us, Tom. As we think about the market since the great financial crisis, we've had these lightly traded rallies followed by heavy volume selling. And the textbooks tell you that that's what you don't want to see. But it's been a terrific move to the upside since then. Yeah. So it's secondary confirmation for us looking at individual stock ideas. I'd like to see volume with the breakouts, but it's not necessarily necessary.
That's right where I wanted to go. I mean, within Stolfus and Wald, Oppenheimer's got some real experience. And the basic idea here is, we haven't seen this before, is it because of the index funds? Is it because of the ETFs? Is it because Michael Barr's in the triple leveraged SPX fund? Is it a new market where technical analysis doesn't work?
Oh, no, I think technical analysis is probably more important than ever, just given the acceleration in indexing and move towards ETFs. Now investors are saying, do I want to buy the XLK or XLF? It's not, do I want to buy JP Morgan or Bank of America? They're all moving the same, and you're seeing the correlations rise and the importance of macro investing and getting you into the right ballpark. And I think technical analysis is a big part of that.
Talk to us about breadth in this market here, Ari, or lack thereof. It just seems like so much of the S&P 500 performance is anchored in a handful of stocks here. Historically, how do you view that?
Well, now we're getting into some of our concerns here. I think anyone trying to say that breadth is healthy here is kidding themselves. This is probably our biggest concerns, that this has been a more narrow move to the upside. Kind of thinking in terms of stocks trading above their 200-day average on the Russell 3000, got as high as 59% more recently, was as high as 70% throughout 2024. Net new highs on the NYSE, 370 in 2024, only about 140 this time around. So this is a yellow light. It's a warning. It's what you don't want to see. I would say it doesn't become a red light until really trading starts to deteriorate here. And I would argue that there's been these offsetting positives. The leadership of the market been very pro-cyclical. We've seen high beta cyclicals outperforming low volatility defensive. So it is a mosaic for us. The breadth piece of the puzzle being the more concern here.
Fabulous. Ari Wald, thank you so much. With Oppenheimer on technical analysis on the charts in the moment.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.